Hi, welcome back to this course on infrastructure finance. This is lecture 2 where we will continue our discussion on analyzing projects viability. In this lecture we will specifically focus on the capital budgeting guidelines. If you look at the previous lecture, we had broadly looked at various capital budgeting techniques. Specifically we looked at techniques like the payback period, the net present value, profitability index and the internal rate of return. And in this lecture what we will specifically do is we will try and see how do we actually calculate the cash flows that is needed on which we can actually deploy these capital budgeting techniques that we learnt about in the previous lecture. But before we get to the lecture of today, we will quickly discuss the thought questions that we actually put forward in the previous lecture. The question number 1 was, what are the shortcomings of using IRR? Specifically if you look at it, IRR is a very intuitive and is a very appealing way to many financial decision makers, simply because fact that it actually gives a project return in a very nice simple percentage. Though it is very difficult to calculate IRR in a manual way, today we have a lot of computing power that is available with us, which will help us to quickly calculate the IRR of a particular investment. Now if you actually have the IRR in terms of percentage, people usually find it appealing because it actually conveys a sense of meaning much more simply as compared to, let us say, a net present value. If you say that a net present value of a project is 10,000, it actually does not convey much, because a net present value does not consider the fact that how much of investment does it actually get into the project. For example, we do not know, for getting a net present value of 10,000, are we actually investing 1 lakh or are we investing another 10,000. But if you look at IRR, the IRR simply says the project returns in terms of percentage, it could be 15%. So if somebody communicates that IRR from a project is 15%, it gives a lot more clarity in terms of how much return is the project able to give as compared to a very abstract net present value that we will get from other techniques such as the net present value or the profitability index. But despite the fact that there are several the intuitive way in which the IRR appeals, there are some shortcomings of IRR that we should recognize. Specifically, we should be aware of one particular shortcoming, which is the fact that there are situations where the IRR simply might not exist. So what are those situations? So if you take an example, let us consider a project with the following characteristics. So you have an initial outlay in year 0 of 1600, and in year 1 you have a project flow of 10,000, and year 2 you have a project cash flow of minus 10,000. Now under what circumstance can this kind of cash flow pattern occur? Year 1 we are very clear that the negative cash flow is because of the initial investment, and year 1 is a positive cash flow that accrue from the project. In year 2 again we are seeing a negative cash flow. The negative cash flow could be because there might be an additional investment that is needed for the particular project. There could be renovation, there could be expansion and so on. So the negative cash flows that occur in between is not a very uncommon feature. There are several areas where we can actually find situations where the project needs additional investment even after begins operation. Now if we have a project that has a characteristic something like this, when you actually try and calculate the IRR, so the IRR what we are going to calculate is the initial investment will be 1600, and this will be equal to 10,000, and we divide it by the discount rate. In this case this will be the internal rate of return, and minus 10,000 is the cash flow in year 2, and this will be equal to 1 plus IRR. So if you try and solve it for IRR, as what you might actually get is, you may actually get an IRR which actually gives more than one value. So if you want to see it as an equation, and this is a quadratic equation of the second order, and when you try and solve it, we may actually get two values for which the equation would satisfy. Essentially, if you want to draw it as a graph, when you plot the curve, it may actually turn out to be something like this. So there are two discount rates for which the net present value is 0. So how do we define IRR? We define IRR as that discount rate where the net present value becomes 0. Now when you are having a situation where the net present value is 0 for two discount rates, which discount rate should we actually take? So IRR in this case does not exist, so therefore we should be aware of situations where IRR simply do not exist. Now under what circumstances do we actually have a situation where IRR would not exist? We will actually have a situation of IRR not existing when there are what is called as multiple sign changes in the cash flows. Now if you look at it, there is a sign change from negative to positive. So there is one sign change in the cash flow, and then subsequently there is another sign change, the sign changes from positive to negative. So there is one sign change from year 0 to 1, and then there is another sign change from year 1 to year 2. So when you have more than one sign changes in the cash flows, then IRR does not exist. So we will have to be very clear about the pattern of the cash flows before we decide to actually go ahead and deploy the IRR method for capital budgeting decisions. So the next thought question that we put forth was, what are the assumptions behind the IRR calculation? So remember, it is very important when we try and deploy a method, when we try and use a method, we have to really understand the assumptions behind it, and we will also have to understand clearly the assumptions behind the IRR calculations. So let us go back to the example that we looked at in the case of IRR calculation. So we looked at a project that had the following cash flows, and we can actually determine the IRR using any software tool such as Microsoft Excel or Lotus to calculate the IRR values of this project. And if you remember, we determined the IRR for this project to be 15.37. Now important assumption behind this IRR calculation is that all the intermediate cash flows that occur in the project life is again reinvested at the IRR rate of return. So for example, if you look at this project, gives a cash flow of 20 in year 1, 30 in year 2, 40 in year 3 and 45 in year 4. Now the assumption when we actually use IRR is that we actually reinvest the 20 that you get in year 1 at the IRR rate of return. So that is, we are able to reinvest 20 in year 1 at a rate of 15.37% for the remaining of the project life. Now it is very important that we have to realize it is not always possible to find alternate investment opportunities that can give fairly high returns. So the project might actually give a return of 15.37%, but we may be finding it difficult to get alternate investment opportunities where if you make an investment we will get a return of 15.37%. So unless until we are not able to unless until we are in a position to invest all the intermediate cash flows also at 15.37%, the project IRR would not be 15.37%, it will be substantially lesser. So if a project has an attractive IRR, let us say 15%, 18%, 20%, we should not really take it at the face value, because we will be able to realize the IRR of 15% or 18% or 20% only when we are able to reinvest the intermediate cash flows at the IRR rate of return. So with this few observations on internal rate of return, let us go to the topic of the day, which is on talking about how do you actually identify the cash flows. In a sense, what we will talk today is about capital budgeting guidelines. So the first task that begins in a capital budgeting exercise is to identify the project cash flows. Remember, when we are actually trying to do a capital budgeting exercise, we actually identify the cash flows and then we discount the cash flows at a rate of return, and then we use any of the technique, let us say an NPV or a profitability index, to determine whether we should implement the project or not. So the first task rests with identifying the project cash flows. Only when the project cash flows has been identified in different time periods, we will be able to use any of the discounting techniques to find out the project's value. So if you look at projects cash flows, they can be broadly classified into 4 categories: the initial outlay, the annual free cash flows, changes to the working capital, and then the terminal cash flow. So when we try and do a capital budgeting exercise, it is very important that we identify the cash flows for each of these 4 components. Remember, it is important that all the 4 components are clearly identified and calculated, lest we actually miss out some of these cash flows, in which case we may not get a proper decision on the project. So let us look at each of these cash flows and then discuss how do we determine each of these cash flows. Let us start with the initial outlay. But before that, let us also identify some important guidelines in terms of calculating the cash flows. The first point that needs to be noted is only incremental cash flows matter. Right? When you are trying to identify the project cash flows, we have to consider only those cash flows that are incremental, that cannot be attributed to the existing project. How do we actually identify whether the cash flow is incremental or not? So there are 2 questions that will help us to determine whether the cash flow is incremental or not. The first question is, will this cash flow occur if the project is accepted? The second question is, will this cash flow occur if the project is rejected? So the response that we get to these 2 questions will help us to determine whether the cash flow is incremental or not. Now what do we actually mean by an incremental cash flow? Let us say we already have an existing power plant and we are trying to increase the capacity of the power plant. So the operating power plant results in some cash flows, results in some kind of revenues. Now if we actually increase the capacity of the power plant, it will bring us additional revenues. Now when we are trying to do this capital budgeting decision, we should only consider those cash flows that are incremental, that is only those cash flows that can be attributed to the increase in capacity. We should not consider the cash flows that are existing, that can be attributed to the plant with the existing capacity. So now let us look at these 2 questions. Will this cash flow occur if the project is accepted? So will the incremental cash flows occur if the expansion is undertaken? Yes, the answer is yes, because if the expansion is undertaken, we will have additional capacity and we will have additional cash flows occurring from the increased capacity. Second question, will this cash flows occur if the project is rejected? Now if the project is rejected, that means we are not undertaking the capacity expansion program, and if the capacity is not expanded, we are not going to get the additional cash flows that we would get if the capacity is increased. So the answer to the second question would be no if the project is rejected. So whenever we are getting an yes to the first question and no to the second question, then we assume that they are all incremental cash flows. Now let us consider the fact that if we consider the complete cash flows of the expanded capacity of the power plant. So let us say the capacity of the power plant initially is 200 megawatt, we are trying to expand it to 400 megawatt, and if we consider the cash flows from the entire project capacity, then will these questions give the correct answers? Now will the cash flow occur if the project is accepted? Yes, the cash flow will occur if the project is accepted. The answer to the second question is, will the cash flows occur if the project is rejected? The answer will be yes, because even if we reject the project, there is existing capacity which will continue to generate revenues and result in cash flows. So if the answer is yes to both the questions, then it is not an incremental cash flow. Only if the answer is yes to the first question and no to the second question, it will be considered as an incremental cash flow. So when we are determining the cash flows, let us remember it very clearly, consider only those cash flows that are incremental in nature. Please do not consider the existing cash flows in your capital budgeting decisions. Second is you have to account for opportunity costs. So what is opportunity cost? Let us say for example you have a particular piece of land and you have leased out the land for a certain amount of money, and now you are considering the possibility of building a project in the empty land. Now when you build a project on the empty land or the vacant land, then you cannot lease out the land for other purposes. So essentially you would not be able to get the lease revenues that you are getting currently. So by trying to construct a building in the vacant land space, we are losing out the existing lease revenue from the empty land. So the opportunity cost of building a constructed space is losing out on the lease income from the land. So whenever we are trying to make a capital budgeting decision, we will have to account for the fact that the increase in revenue will be because of constructing a new building, but at the same time we will not be getting the lease rental on the vacant land. So that should be considered as a cost, that should be considered as an outflow, and if we do not account for this opportunity cost, then we will not be able to make the proper decision. And guideline number 3 is you will have to account for working capital requirements. Remember, working capital requirements is a very important aspect of business. For a business to operate in a fairly unhindered manner, there has to be adequate amount of working capital. What are the components of working capital? The components of working capital is inventory, accounts receivable, and a certain amount of cash to meet the business exigencies. Now the inventory is needed to ensure that there are no disruptions in the operations of the business. So it is an essential investment that is needed for the routine business operations. Similarly, customers would expect credit, and if credit is not given, then it will be very difficult to actually engage with customers, and therefore it might actually affect the revenues as well. So we will have to consider for the fact that there might be additional working capital requirements that are needed with the implementation of a project, and this increase in the investment in working capital needs to be considered when we are identifying the cash flows. The fourth guideline is we will have to ignore sunk costs. Now what is a sunk cost? Sunk costs are those costs that are incurred before starting the project, before we actually considering the evaluation of the project. Costs that are incurred in the past should not be accounted for in a future decision making. So how do we actually account for sunk costs? So sunk costs could be actually accounted by trying to answer the two questions that we posed earlier. Will this cash flows occur if the project is accepted? Sunk cost is a cost that has already been incurred, it is not going to be incurred again. So if the project is accepted or not does not really matter, this cash flow will not occur if the project is accepted. Okay. Look at the second question, will the cash flows occur if the project is rejected? Again the answer is no, because this is the cash flow that was occurred in the past. So therefore the answer to both the questions is no. Then it is a sunk cost, it is not an incremental cash flow that we will continue to incur if the project is accepted. So whenever we are not very sure whether it is an incremental cash flow or whether it is a sunk cost, it is better to pose ourselves these two questions, and the responses to these two questions will help us to determine whether it is an incremental cash flow or whether it is a sunk cost. If it is a sunk cost, then we have to ignore the sunk costs, and if it is an incremental cash flows, we include only those incremental cash flows. Okay, I hope now you have broad clarity in terms of what are the basic principles that we actually have to use in identifying the cash flows. Another important component is any cash flows that are pertaining to financing cash flows should not be considered. So what are the financing cash flows? It could be the interest payments, it could be your principal repayments, it could be your borrowing, and so on and so forth. Now these are all cash flows, these are all real cash flows, but this should not be considered when you are actually making your capital budgeting decision, because when you are looking at interest payments are essentially in the nature of cost of capital, and we already include the cost of capital in the discount rate. Remember, we actually have cash flows occurring several years in the future, and when you actually want to bring it down to the present, then we discount it at the cost of capital. Now if we consider interest payment again as an expense, then we will actually be double counting the interest costs, double counting the cost of capital, and again this will lead to errors. So we should ignore the interest payments and cash flows related to financing, and we should ensure that all these 5 guidelines that I have just mentioned have been clearly adhered to, and if you need to be making an error free calculation on capital budgeting, then we should not ignore or overlook any of these important guidelines. Next we will look at trying to identify the cash flows, the 4 different cash flow components that we talked about a while ago. Initial outlay. So what is an initial outlay? Initial outlay is the investment that is needed till the project begins operation. Okay. So you may actually need the initial outlay for a variety of purposes. So for example, you may want to actually buy equipment, it could also be in terms of installing the equipment. So many times you actually have to incur a substantial amount of investment in installing the equipment at the site. Let us say for example, in the case of a power generation plant, we actually get the equipment such as turbines from the equipment manufacturer, but then it has to be installed at the site, and there is a lot of investment that is needed in terms of installing and testing the equipment at the site. So this initial installation is also considered as a part of your initial outlay. And then we have let us say for example a project which involves substantial amount of construction. It could be let us say a road project or an airport project, where in addition to all of this there is a lot of construction related activity and investment needed. So that is also considered as a part of your initial outlay. So essentially we have to understand the initial investment needed till the project begins operations is something that we will have to account for as your initial outlay. So the next component is identifying the operating cash flow. So cash flow from operations begins from the time the project start producing and start offering services. So how do we actually calculate the operating cash flow? So the operating cash flow is nothing but net income plus depreciation. Now cash flows, it is very important for us to understand that cash flows is not revenues. Revenues is actually the sale made by the company from its products and services. Now the company will have to meet its various expenses, operating expenses from the revenues. So in essence there is actually a certain amount of cash inflows in revenues, and there is a certain amount of cash outflows in terms of expenses. So therefore the cash flow that we actually get should be net of all of these expenses. Only those cash flows are available for the investors. Revenues after meeting all the expenses is what we actually have recourse to as investors. So therefore operating cash flow is not really revenues, but essentially it is net income, that is profit after tax, and then we add back the depreciation. Now why do we have to add back the depreciation? Because depreciation is not really a cash expense, it is not really a cash outflow, and therefore we will have to add the depreciation back to the cash flow from we have to add back depreciation to the net income. I will give you a simple example so that you can understand how do we actually determine the cash flow from operations from, let us say, a financial statement or a financial projection. Let us say there is a company which has revenues of 1000. The company incurs several expenses to the tune of about 500, and then the company's depreciation is 150. So therefore the earnings before interest and tax, would be 350. Earnings before interest and tax would be 350. Now if the company actually has taken certain amount of loan, then the company would need to pay interest on this earnings before interest and tax. So in a normal profit and loss account, what you would find is there are payments towards interest payment, but in a capital budgeting decision we have discussed earlier that we should not consider interest payments or financing cash flows. So therefore we straight away determine the tax payment that needs to be made on this income. So if you assume that the tax rate on this income is 34%, the tax rate is 34%, then we pay a tax of 119, and the profit after tax it becomes 230, becomes 231. Now we will have to calculate the operating cash flow using this information that we have just indicated. Remember, please do not consider interest expense, right? We will straight away have to account for the tax at EBIT level and then determine your profit after tax. Even if the project is going to borrow, which will lead to some amount of interest payments, we should not treat interest as an expense because of the fact that we are considering this under the cost of capital when we discount the cash flows. All right. So now the operating cash flow is going to be profit after tax plus your depreciation. So profit after tax is nothing but net income, that is income net of all expenses. Okay. So the operating cash flow for the example that we have stated is 231, which is the profit after tax, and then the depreciation of 150. So the operating cash flow is 381. So operating cash flows is not revenues, operating cash flows is not profits, operating cash flows is simply sum of net income plus depreciation, which is 381. So when we are actually calculating or estimating operating cash flows, this is the way in which it needs to be estimated. Next we consider the changes in working capital. So working capital changes is treated as changes to cash flow. For example, if you actually increase in working capital, specifically if there is an increase in net working capital, it is treated as a cash outflow because the investment that is actually made in working capital is not available for any other purpose. Unless until the working capital is liquidated, the investment is stuck and the cash that is used for the purpose of making working capital investment is not available for any other purpose. So therefore any increase in working capital is treated as a cash outflow. Let us say for example the company is increasing its inventory levels. When the company is increasing its inventory levels, the current assets increase, and obviously when the company is stocking up increased inventory, it needs to pay more for accumulating that inventory. And so in essence, though the cash does not leave the company, the cash leaves the company, but then it is transformed in some form of current asset. In this case it is transformed as an inventory. So this cash is not available for use for any other purpose. So therefore we consider any increase in net working capital as a cash outflow. Now by the same token, any decrease in net working capital is also treated as a cash inflow. Let us say for example, if there is an increase in accounts payable, right? If there is an increase in accounts payables, that means the current liabilities is increasing, then the net working capital will reduce. Net working capital is nothing but current assets minus current liabilities. Now if current liabilities increase, then the net working capital will reduce. So this increase in current liabilities or a reduction in net working capital is treated as a cash outflow, cash inflow, because when we are delaying making payments to our suppliers, the cash is available for use for some other purpose, right. So therefore it is treated as a cash inflow. Another important point that needs to be noted is, upon termination of the project, upon the project reaching its end life, the working capital is assumed to be liquidated to cash at the book value. So whatever investment that is being made in working capital is assumed to be liquidated at book value, because at the end of the project life we no longer need those investment in current assets. Why do we actually need to invest in inventory? We no longer need suppliers who need to supply materials to us. So therefore there is no investment needed in working capital at the end of the project. So we assume that we are going to liquidate all the working capital investments and treat it as a cash inflow on termination of the project. Now if you are not able to, or if you miss accounting for this liquidation of working capital upon project termination, then we are missing an important part of project's cash flows, and there could be errors in our decision making. And then the final aspect of cash flows is your terminal value. So terminal value is nothing but the cash flow from disposing the assets upon termination of the project. So let us say the project has a life of 5 years. At the end of 5 years, the assets that we have initially constructed, the initial outlay that we have initially made, has no other use. So therefore we can liquidate all the initial investments, we can liquidate all the assets and treat it as a cash inflow. So the terminal value would be either a salvage value if you are disposing of the assets upon termination of the project. So it is very important that we also account for that. I mean, if the project does not have any salvage value, then the terminal value becomes 0. But on the other hand, if you are able to sell the assets in the market, if you are able to sell the assets in the market at even at a scrap value, then we should be able to bring in the terminal value as a project inflow upon project termination. Now let us look at a simple example for calculating cash flows. So the example is a project which has a 5-year life, and in each of the years it is making certain amount of sales. For example, in year 1 the project is able to sell 50,000 units and the price per unit is 150. There are some costs associated with setting up the project. So the cost of the new plant, equipment and installation is 10 million. So for running the project, for running the plant, there are some costs that are incurred on a yearly basis. For example, there are some fixed costs to the tune of about 500,000 every year, and then there are certain amount of variable costs which depends upon the number of units that are produced in a given year. So the variable costs are about 80 per unit. In addition to that, there are some investments needed in working capital. For example, to begin the project, there is a need for working capital investment of about 100,000, and then subsequently every year the investment in working capital will be to the tune of about 10% of sales of a particular year. So it is a very standard assumption to make that as the company increases in size, there would be additional investment needed in working capital, and it is also usually approximated for ease of calculation that working capital can be considered as a function of the firm sales. So if the firm sales increases, then people normally assume increase in working capital as a percentage of the sales value. So in this case we assume that the working capital investment for any particular year when the project is in operation is 10% of the sales done for the particular year, and the project will follow a straight line depreciation with no salvage value. So that means at the end of the project life the assets do not have any value. Even if we dispose of the assets, we will not get any cash from the disposal. So there is no salvage value, there is no terminal value in this particular project. Now this is just an illustration. Very rarely you will actually find projects with no salvage value. In most cases there will be at least some scrap value which one can get by disposing of the assets. And then we also assume that the tax rate is 34%, and then we can also assume that the cost of capital for the project is 15%. Now with this information, can we actually calculate the different type of project cash flows? So let us start with one by one. So first is we will start putting the different years. And we will start with the different cash flow streams. We will start with the initial outlay. So the initial outlay, the initial investment needed the beginning of the project. So the initial outlay which happens in year 0 will be 10 million, will be 10 million. Let me state everything in terms of thousands. The initial outlay will be 10 million. So this completes identification of the first cash flow stream, which is your initial outlay. Then we will actually have to account for your operating cash flows. We will have to account for your operating cash flows. So what are operating cash flows? Operating cash flows are nothing but the profit after tax plus your depreciation. So for each of the years we will have to determine the profit after tax and then your depreciation. So what is the profit after tax for year 1? So I will give an illustration for year 1 and have you to determine the operating cash flows for the remaining years. In year 1, revenues are nothing but the number of units sold multiplied by the selling price per unit. So the number of units sold is 50,000 in year 1 multiplied by the selling price per unit 150, and this will actually give you revenues of 7,500,000, so 7.5 million. And then we will have to account for the cost. Cost is nothing but the summation of the variable cost and fixed cost. Variable cost is 50,000 multiplied by the number of units that is produced 80, which is a variable cost per unit, plus your 500,000, and the total cost will works out to be then we have what is called as your depreciation. So, depreciation is a straight line depreciation with no salvage value. So, that means we assume that the initial outlay is depreciated equally for all the 5 years. So, we made an initial outlay of 10 million and this 10 million is depreciated equally in all the 5 years. So, that means for every year the depreciation is 2000, right? Every year the depreciation is 2000. So, this leads to earnings before interest tax of 1 million or 1000K, and we consider the tax to be 34%, will be K, and then your profit after tax will be 660. So, this is the projected profit after tax for year 1, and we will have to calculate the operating cash flows. See, operating cash flows are nothing but the profit after tax plus depreciation. So, this will be 660 plus 2000K, and this will be 266. So, now we can actually, using the same procedure, calculate the operating cash flows for the remaining years, which so we can calculate it for the remaining years, and this turns out to be 4970 in year 2, 4970 in year 3, 3584 in year 4, and 2000 in year 5. So, you will have to find out the revenues and costs that we did for year 1 for each of the 5 years, and then add up the net income for the respective years with the depreciation of that year to calculate the operating cash flows for each of the years. So, we have completed 2 cash flow streams. The third cash flow stream would be changes to working capital, changes to working capital. So, changes to working capital are nothing but, initially we will have to incur an investment in working capital of 100,000, and then for every subsequent year the working capital investment is 10% of sales. So, for year 1 if you look at it, the sales is 7.5 million, and therefore working capital investment in year 1 will be 750. So, like that we will have to determine the working capital investment for each of the years, which will be 10% of revenues. So, the changes to the working capital would actually be considered as having an implication on cash flow. If there is an increase in working capital, so that means there will be a reduction in cash flow. If there is a decrease, there is going to be an increase in cash flow. So in year 0 we are making an initial investment in working capital of 100k, so therefore this is a cash outflow of 100k. So working capital increases from 100,000 to 750,000 to year 1, so that means there is a difference, there is an increase of 650. So the change in working capital is 650k in year 1, and since there is an increase, this is considered as a cash outflow, so therefore we denote it by a negative sign. In year 2 it increases from 750 to 1500, there is an increase of 750, so there is an increase of 750, and since an increase is considered as a cash outflow, we denote it by a negative sign. There is no change from year 2 and 3, so there is no change in working capital, so it is 0, and from year 3 to 4 there is actually a reduction in working capital, that is considered equivalent to that of a cash inflow, right. There is a reduction by 450,000, so since this reduction treated as a cash inflow, it is positive. And in year 5 there is a reduction in working capital, which is your 400k, and we also assume that upon project termination the entire working capital will be liquidated, and then it will have to be treated as a cash inflow upon project termination. So therefore in year 5 the change in working capital will be 450,000 plus 650, and this will be 1050. So this is the third component, that is the changes in working capital that affects your project cash flows. So it is minus 100,000 in year 0, and then subsequently we have for the respective years. And then the fourth would be the terminal value. So the terminal value we assume to be 0 because the assets do not have any salvage value. Upon disposal on project termination we get nothing, so in this case the project terminal value at the end of the project life becomes 0. So for a project that we have looked at as an example, these are the cash flows for each of the different cash flow streams: for initial outlay, for operating cash flow, for changes to the working capital, and then your terminal value. Now in the next lecture we will try and see how we actually use these different cash flow streams to make a decision on to invest in this project or not.